Okay, welcome to our web edition of What's the Big Idea? This is the event that we held this morning for our clients and friends, and it's open to anybody who wants to come and find out what we've been watching over the course of the last month and wants to find out what our big idea is for the month. So it went over well. This month we're talking about a small firm called Blue Knight Energy Partners. So let's get to it. Every month we host these events to share what we do, and this month is no different. So I always show the introductory slide on Cush Capital to start off with, so that we can share a little bit about how our firm was created and what we focus on. So slide number 2 tells you a little bit about our firm. We focus on better research. We really enjoy digging into the companies that we own and talking to the management teams and digging through SEC files. I guess you could say we're nerds at heart, and we create a business around that. And we custody all of our client assets through either Fidelity or Schwab, and then we simply have an agreement with our clients that allows us to manage those investments on their behalf in a manner that's appropriate for their particular risk tolerance. So it's very simple. We say that we practice golden rule investing, which simply means that we have our own capital invested alongside of our clients. So we wouldn't have it any other way. To us, that's a part of operating with a sense of integrity. And that's not common to all advisory firms, so I always pause and make a special purpose to point that out. We're very conservative in our approach. We like to quote Warren Buffett when he says that the first rule of investing is not to lose it, and the second rule of investing is to not forget rule number 1. We practice a biblically responsible approach, and we are certified Catholic practitioners, which doesn't make us the moral authority on anything, but it's our little effort to more fully integrate who we are on Sundays with who we are during the rest of the week. So, and then we seek to do business with like-minded investors, and part of the reason we do these events is to communicate to our clients and create a dialogue, because we find their feedback extremely valuable. We have a very valuable client base, so we do business with a lot of business owners, and what they're experiencing out there in the real world is meaningful to us as we try to manage a portfolio. So our ideal client will engage with us a little bit, and we all benefit from that. And then we also share what we do in an attempt to find new clients. So if after listening through this whole presentation you are thinking to yourself, that's you, then engage with us via web or email or phone call, and let's find out a little bit more about Blue Knight or something else we've said today. So slide number 3 is graph that shows total U.S. debt outstanding, and this is a chart that we share at every one of these events that we do, because more than any other single data point that we look at or that we share, this influences what we do more than anything else. This slide shows total debt across all sectors of the economy. That includes household debt, state and local, federal, domestic financial, business, foreign, and as it stands now, the value of that debt is over $60 trillion, not including entitlements. When you put entitlements on top of that, we are in excess of $100 trillion. Now that number is way too big for me to wrap my head around, and for most people, that's just the number's too big to understand. So we share some of these subsequent charts, which are new this month, in an attempt to help us and our clients understand the magnitude of what we're up against. So slide number 4 shows some chart that was created by the Heritage Foundation, and you can see here that it shows debt as a percentage of GDP. And the highest ratio we've ever seen our country's debt as a percentage of GDP was after World War II, when it peaked out at 108%. Today it's near 100%, and as we extrapolate the path that we're on, by 2036 we can expect that to go to 195% of GDP. This is a ratio that we've never seen before and would have crippling effects on our economy. So let's look at slide number 5. to put that in greater perspective still, and we can see there that that path takes us beyond Spain. It takes us beyond the United Kingdom, Italy, Japan, Greece. If we continue to spend $3 for every 2 that we take in, what we're seeing now in Greece is a preview of what we will experience here in the United States. So we are very mindful of this. Let's move on to slide number 6, which shows the same data and in a little bit more detail. It shows what happens as our debt increases as a percentage of GDP and the components of that. And you see here in yellow that net interest becomes a larger and larger share of our total capital outlays at the federal level. And this makes perfect common sense. The more debt you take on, the more interest expense you have to pay. And as the debt increases, then the portion of that interest expense also increases. We call this the path to socialism. Now, this won't happen, this can't happen, but our country and our politicians need to make the difficult decisions to prevent this from happening. And those difficult decisions are raising taxes, lowering benefits, or increasingly what we feel like is going to be a part of the solution is to stealthily increase the money supply so that we can pay back some of these debts with dollars of lesser and lesser value. And we're positioning our portfolio accordingly to benefit from what we feel are going to be inflationary effects at some point in the future. Also on this chart you see the red line here, which represents the average historical tax revenues as a percentage of GDP at 18.1%. So in the long run, the blue line on this graph and the red line on this graph have to come together. In the short run, a period of 1 to 3 to 5 years, we can have deviations as we borrow or save more in a short period of time. But in the long run, our tax revenues roughly have to match our government outlays. And that's just the math behind the problem. And it highlights the difficulty of the decisions that we're going to have to make. These aren't easy decisions because they result in sacrifice. We can manage our way through a period of sacrifice, but historically speaking, that tends to be a very difficult time for the markets and allows us as portfolio managers to position our clients' accounts with excess cash in an environment like this because we feel like it's prudent. Okay, slide number 7 highlights a data point that we cherry-picked from the CBO report, Congressional Budget Office report, dated January 31st of 2012, where they noted that between 2012 and 2014, revenues in the CBO baseline shoot up by more than 30%. And this is as a result of the failure of the super committee in the fourth quarter of last year. Couldn't reach any agreement. So the Bush tax cuts are set to expire in 2013, and the rest of the budget will experience across the board somewhat draconian type cuts. The result of this is going to be an increase in government revenues, also known as your taxes, by 30% between now and 2014. Your taxes go up, and you have less money to spend. That means that corporations make less money because they're selling fewer products to the end consumer. The consumer is 70% of our economy, remember. That creates a headwind for the markets because corporations are having a very hard time increasing their earnings, and again creates an environment where we feel like the most prudent approach is to be very conservative in our investing stance. So the rest of the slides in this deck are old. Wait, with the exception of number 8. So let me go to slide number 8 here. This is the debt ceiling. So we found this in the last month, and as is typical, we spend our days and our weeks and our months culling hundreds of different data sources. So periodicals and newspapers and blogs and conversation with management team and SEC filings and every different data source that we can get our hands on, we reference to help support the decisions we make in our portfolio and the research we're currently doing for our investments. And we found this chart this month, which is very interesting because it shows the change in the debt ceiling that we implemented last August. We raised our debt ceiling from 15.1 to 16.3, and at the time this was designed to push the issue down the road past the November elections. The point of this chart is that as we continue to spend in a very profligate manner, it now looks as if there was a miscalculation and this debt ceiling will have to be raised again during the third week of August. Now there are some puts and takes that the federal government can use to extend that a little bit, potentially even by tapping some of our trust funds beyond the November elections. But one thing I know with certainty is that the opposition party will move to politicize this issue in advance of the elections. And as they do that, we expect volatility in the markets, much like we saw in the third quarter of last year when the politicians reached agreement at the 11th hour, but in the process caused the U.S. to lose our AAA credit rating and subsequently caused a decline in global markets of nearly 20%. So plenty to be cautious about in the near term. Okay, there's lots more slides in the deck that we shared with our clients this morning, but these have all been reviewed in the past. If you see something in this deck, reach out to us if you want more information on it. But I won't take up any more of your time today with debt data that we've reviewed in the past. But collectively, this file holds much of the data that we use to support our current portfolio position, so we like to include it in sum total. Before I move on to Blue Knight Energy Partners, I do just want to pause and talk about slide number 28. So slide number 28 details what we call the 3 M's, and we wrote about this in our newsletter last month. So if you go to our website and you pull up the April 2012 newsletter, we go into detail on our 3 M's approach to investing. This is the filter by which we review all of our investment candidates internally, and it stands for management team, moat, and mispricing. Everything that we put client capital to work in has to pass the 3 M's test. And management team is very simple, but it's very important. The longer I'm in this business, the more important pairing our capital with other investors of high integrity becomes. It is the key most data point, or the key most thing that we look at when it comes to protecting our clients' capital, and that's pairing it with management teams of extremely high integrity. We also look for companies that have a moat, and the concept of a moat harkens back to the Middle Ages. The wider and deeper castle's moat, the more effective they are at fending off competition. We want to invest in companies that have similar type aspects that allow them to hold their competition at bay and sustain higher margins that they can use to compound our clients' capital for years and years and years into the future. Moats can show up in many different forms. You might think of a utility, the monopolistic type nature of a utility. They are regulated entities, and that creates a monopoly, if you will, in their business and allows them to sustain their profit margins. Another example of a moat might be a trademark or a patent that prevents competition from entering a particular industry and creates barriers to entry. Coca-Cola is a great example of a company that has a moat in its brand, or Walmart with its economies of scale makes them the low-cost manufacturer, low-cost distributor of goods, and creates a moat for Walmart. Thirdly, we look for mispricing. If we have the first two and we don't have mispricing, we'll be a complete and utter failure as investors. So we have to identify companies with great management teams, moats, and then we have to have the mispricing. When we get all three, we have a great opportunity that we can capitalize on behalf of our clients. And we do have all three with Blue Knight. So beginning on slide 29, we have Blue Knight Energy Partners. The ticker is BKEP. The ticker to the preferred offering, which we've invested in, is BKEPP. And I will highlight some of the difference and explain why we chose to take a position senior in the capital structure, which we were just a little bit more comfortable with. So slide 30 is a picture showing 6.7 million barrels of capacity owned by Blue Knight Energy Partners in Cushing, Oklahoma. Cushing is the delivery point for all of the crude oil futures that are traded on the NYMEX. So So they own about 10% of the capacity at Cushing, and these are contracts that are, the duration of these contracts are over a period of several years and creates very stable cash flows. Slide 31, they own 1,285 miles of crude oil pipeline. So we like pipeline businesses. It's a business that we feel like we can understand. It's a business that we feel like is inside of our circle of competence. We can go out to the field, we can look at the pipeline, we can touch it, we recognize that oil flows from point A to point B, and it's a pretty simple business, and Blue Knight gets paid to transport that oil from point A to point B. They also own, on slide 32, they also own 44 coast-to-coast liquid asphalt storage facilities. And what we like about this part of their business is that they do not operate these facilities. They own these facilities and they rent them to the operator. So that significantly reduces the risk profile for a company like Blue Knight Energy Partners. And when you reduce the risk profile, you increase the certainty by which we as investors can have and incorporate into our investment thesis. And well, what that does is it makes us more confident in Blue Knight's ability to pay us the 8.25% dividend that they're paying on their preferred units right now, which is all we really care about as investors. So all of these leases on their asphalt storage facilities are triple net, which means that Blue Knight is not responsible for any maintenance capex. So if the facility needs a new roof, they're not responsible for putting a new roof on it. They're not responsible for any property taxes. They're not responsible for any insurance. All they have to do is collect the rental payments. And again, we like the stability that adds to Blue Knight's business model. Okay, moving on, slide number 33. Blue Knight also owns some crude oil and transportation facilities. When we spoke to their CFO, Alex Stallings, he made a special point to point out to us how new their trucking fleet was. And that's important to us because it means that Blue Knight is not going to have to invest a bunch of capital in new trucks next year or the year after that or the year after that. And if they're not investing the capital in new trucks, then they will be more likely to pay us our dividend, which we care most about. So again, that's a small data point, but a meaningful data point because it increases the likelihood of our distribution, our dividend, accruing to us as unit holders. Okay, so slide number 34 shows geographically where these asphalt terminaling facilities are in the triangles, and then their pipeline and storage facility assets in central Oklahoma and northern Texas. So let's move on to slide number 35, and we'll talk about their management team and their moat and their mispricing. Before I get into the management team, I want to pause and just mention that Blue Knight is a master limited partnership. And that's a little bit different from the legal structure of your typical corporation. As a master limited partnership, they receive favorable tax treatment from the government. They can pass down all of their distributions tax-free at the corporate level. So we pay taxes as the unit holder, but there are no taxes at the corporate level. Because of the way they're organized, MLPs will have a general partner and limited partners. And we are advocating here an ownership stake in the limited partner and in the limited partnership units, and specifically the preferred limited partnership units. So the general partner comprises the managerial team and is 50% owned by Charles Bank and 50% owned by Vitol. So that's the management team that we're dealing with here in the general partnership, and it's a high quality management team. It used to be that these assets were managed by a company called SEM Group, and we were interested in investing in SEM Group several years ago and ultimately passed on the opportunity, and SEM Group's parent got themselves involved with some derivatives trading and was on the wrong side of a few options and futures agreements that went bad, and ultimately they had to file for bankruptcy on account of that. And Blue Knight is the company that emerged from those bankruptcy proceedings. It's important to note that they are entirely through the bankruptcy. This is all in the past now, and to their credit, the quality of these assets that Sem Group used to own and now Charles Bank and Vital own, well, the fact that Charles Bank and Vital own them now is a testament to the quality of these assets. So Charles Bank here, you can see on this slide, is a private equity firm with a long history of investing in the oil and gas assets, and their track record validates our thesis behind Blue Knight, and it also validates the quality of the assets. And the same thing can be said about Vital, which owns a 50% stake in the general partner. They are the world's largest independent oil trading company, which gives them a very unique perspective on the business, and not only the value of these assets, but the value of all of the assets going into Cushing and elsewhere throughout the value chain. So we like that they are a 50% partner, and we also like that they contract with Blue Knight for a very large percentage of the storage capacity in their Cushing facility. So because Vital is a 50% owner, it behooves them to negotiate a fair rental agreement when these contracts come up for renewal, and the next one will come up for renewal in June of this year. So we have a management team that we like. We have a management team with a tremendous background, and we have a management team with very deep pockets in Vital. So let's look at their moat. Slide number 36 talks a little bit about their moat. These assets are very easy to understand, especially when it comes to assets like a pipeline. You can see how it would be uneconomical for any other company to build a pipeline from geography A to geography B. Once there's already a pipeline there, it just wouldn't make any sense. And that creates a monopolistic type of attribute to their business that we really like, and results in very stable cash flows. We also like that they have long-term contracts. 43 of their 46 asphalt terminaling facilities are contracted out on average through 2016. Again, gives us a lot of certainty with regard to the cash flows that Blue Knight has. And as I already mentioned, Vital is their largest customer. So, moving on to slide 37, and this is the most exciting slide of any investment opportunity, and that's the mispricing. How much money can we make? That's what we all really want to know. And with Blue Knight Energy Partners and the Blue Knight Energy Partners preferred units, we can right now buy at $8.65, which is where they closed yesterday, and expect to make 8.25% on the distribution that they're paying to us as unit holders. And these distributions are guaranteed in so much as they have preferential treatment above any common distributions that they would issue to their common unit holders. So that gives us a senior position in the capital structure, which we like. The coverage ratio was nearly 2 times last quarter, and for any of you that aren't familiar with the coverage ratio, that's simply how much money they earned in cash flow versus how much they paid out in distributions. So if Blue Knight earned $100, then they paid 50 of that out in preferred distributions, and they covered it by about 2 times. Very meaningful to us, because that means that their cash flows could potentially contract by 50% before they failed to pay us the distribution that is so important to us as unit holders. So that provides us with a large margin of safety when we own the preferred units. And then I also note here that the assets are hard assets, and these contracts reprice periodically, and in an inflationary environment it would be reasonable to expect some of those contracts to reprice at higher levels. So we have some embedded inflationary protection built into the business model, which is tremendous, and we're attracted to that. And then lastly, I note here that because Blue Knight is a post-reorg bankruptcy, I thought it was worthwhile to note that as a group or as an opportunity set, post-reorg bankruptcies have historically been a very profitable area of the market to invest in. It's typical for a firm to reorganize itself in bankruptcy and reissue its stock and work with its investor relations department in some of the larger Wall Street banks, say Wells Fargo or Barclays or Morgan Stanley or Merrill Lynch, to launch coverage on a company and work with their affiliate of brokers to increase the awareness of a firm after its bankruptcy. And this typically serves as a catalyst to push the stock higher. And the evidence of that is in the performance of the universe of post-reorg bankruptcies over the last 10, 20 years. They typically do very well. That is not a part of our investment thesis on Blue Knight, but we do recognize that it's out there and could potentially serve the unit holders well. So that is almost the last slide. Slide 38. There are some other things that I need to mention about Blue Knight for anybody that might be watching this and thinking about picking some up for their personal portfolio. Because it's an MLP, they do not get taxed at the corporate level, which I mentioned, but that also means that at the end of the year you'll receive a K-1 instead of a 1099. So as a unit holder, you need to recognize that it's very common for these K-1s to be delayed into late March or sometimes even early April. So you should have it in the back of your mind that there's a higher likelihood that you're going to need to file an extension. If you buy into Blue Knight, you might almost condition yourself mentally to just count on filing that extension. Your life will be made easier by it. You also need to be careful in purchasing these in qualified accounts because there are some stipulations around how these distributions are treated from a tax standpoint. And typically in a 401k account or an IRA account, you don't have to worry about the income generated because it's tax-free until distribution. That doesn't always hold for MLPs. And the IRS looks at something that they called Unrelated Business Taxable Income, UBTI. If UBTI exceeds a $1,000 threshold in your qualified account, then those distributions become taxable. So you need to be very careful about this. We wrote about this in detail in our September 2001 newsletter, which you can also find on our site. We were talking about a company called El Paso Pipeline Partners at the time, but we explained to investors how UBTI is typically calculated and some of the pitfalls that you need to be aware of. So make sure you check that out, or just call Cush Capital and we can help you out with this. That's what these events are really all about, is growing our business. So slide 39 is a call to action. Again, call us to find out more about what we do, how we think, what we're interested in. We will do another What's the Big Idea on June 13th at 7:30 in our offices. So please show up and engage with us in real time. We'd love to see you. And I also have a plug here for a monthly investors club that doesn't have anything to do with Cush Capital, but we host it in our offices. So we have a group of investors that like to get together and just round table ideas. It's a very casual, laid-back atmosphere, and periodically we'll get a great idea from that club that we can put to use on behalf of all of our clients. So if you love that type of atmosphere and you love these types of conversations, then reach out to me and let me know, and we can get you involved in something like that. So thank you for your time. Thank you for tuning in to this month's edition of What's the Big Idea, and I'll see you next month. Thanks.